Welcome back to another under 450k video, and in this video we're talking about Mackay. And before I go into any analysis of the video itself, we need to acknowledge that Mackay is a very hot market. It is incredibly competitive. There are so many buyers agents there buying at this very point in time, and then you've also got the normal retail investors who are also clouding into this market and paying lots of money for properties in this area. So then you ask the question, is there still areas left in Mackay which you can consider as an investment opportunity? And my answer is yes, with certain risks involved. And I'm going to explain all of that in this video and break it down for you. So make sure you are watching through till the very end to actually understand. And if you don't know where Mackay is, it's in regional Queensland. It's a very hot market. And the first thing I'm going to do is actually break it down on the LGA level. And on Mackay, you can actually see that the median price is $613,000 at around a 4.65% yield is what you can expect to get. You can see it has 120,000 people. So it's not some small regional town. It is quite populated, it is quite dense, with a very good infrastructure spend, as we can see. And the first thing you'll notice is that Mackay has been growing very strongly for the past 3 years, and just in the past year alone, you can see it's grown to close to 20%, which is a significant amount of growth. And can we see this trend continue to 2025? Well, most likely. And you may ask me, what are the indicators for that? Well, I'm going to show you. If we start to scroll down, we have to always look at supply and demand metrics. And when we look at the stock on market, we can see that it is still plummeting, it is still going down, and days on market as well is also trending down because properties are being sold faster and there's also less listings coming onto the market. So demand is high and supply is low, which is the anchors of capital growth. You can see building approvals is 311. That's still not a lot considering the population is 120,000 people. The other key indicator we want to look at a region level is the affordability metric, and the affordability is still sitting under 30 years, which means that for local residents, this area is still very affordable despite all the growth it's had since 2022. Now, one thing I do want to call out straight off the bat, and you're going to see this trend more and more often, is the fact that vacancy rates are starting to go up. And that's because there's just more investment properties in the area because there are a lot of investors buying up the property within Mackay. Naturally, as more and more investors buy property in Mackay, we're going to see that vacancy rate start to increase and the rental yields drop further and further. In fact, we can already start to see this as the yield has dropped down to about 4.6% in Mackay's LGA. Now, of course, there are still pockets within Mackay that are still very good to purchase in and are still a good option if you can secure a property. And I'm going to break that down a little bit later, but I'm going to still keep going with Mackay on an LGA level. But before I get into that, if you have not already, make sure you subscribe to my private community. We have over 100 members within that community. It has grown so much. I cannot thank all of you, and I also want more people to join so you can come in, collaborate, use my resources, share my knowledge, and just make your investment journey that much easier. It's an absolute no-brainer. It's $35 a month. So if you're looking to invest in 2025, make sure you press that join button because it's only going to help you. And generally speaking, Mackay's economy is actually very strong, which is home to about 126,000 people for about 54,000 jobs with an economic output of 26.37 billion, which is a lot, and we have to break it down a little further than that. Over the past couple of years, Mackay's GRP, its gross regional product, has been increasing in 2022 about 10.5 billion, in 2023 about 14, and 2024 again $14 billion. And if you have not seen this already, there's actually a really good report on Mackay's region economic profile released in July of 2024 by the local council, which you must read if you plan to invest into Mackay so you know what you're getting yourself into. And once again, if we have a look at this, we can see that $13.9 billion in gross regional product, and as well, we have another 13.2 value added generated in 2023. And this economic output can be broken down further into mining, manufacturing, construction, giving it a total figure of $26 billion. We can see that mining is a big factor in Mackay's region, equating to about $7 billion in its last year, which is a lot of money. And there are some downstream services into manufacturing and construction because of that, but it is still an overall well-diversified economy in multiple different industries. And there's also another $4 billion coming from other sectors as well. So it's not just a one-trick pony as some might be led to believe. And when we look at the number of businesses in each sector, we can see that agricultural, forestry and fishing equates to a large number of businesses, almost 2,000, as well as construction, another 1,600, and in mining, 100 businesses, which still equates to the largest economic output of the region. And as you can see from this simple report, which you can read yourself as well, it is still a very economically diversified region that is a good place to invest both short and long term. Now, I must say, mining does contribute a significant amount to its economic output, and if it does collapse for whatever reason, it could and will likely have an impact on the housing industry within Mackay. Now, it may not be crashing the house prices, but it could certainly have an impact which could cause house prices to decline or flatline for a long period of time until the industry gets back up on its feet. So that is a risk that you should be aware of when investing into that region and not to go in there blindly. And I also want to say this, that when you look at a region to invest into, you must also compare that with another industry and put them side by side to determine which is the better investment location for your personal circumstance. Because just looking at a region in isolation doesn't actually mean much. And by the way, here's another website where you can go see the diversification of employment within Mackay, with health and social care employing about 8,300 jobs as well. But let's get on to the part that everyone wants to talk about, which is where exactly in Mackay should you be investing? Because Mackay is a big place. And if you have not already, make sure you go buy my book, No Gatekeeping Property. It's $9.99. It is so cheap. It's cheaper than a KFC box meal. I always refer this. I don't know why, but I always do. It's so cheap. It's an absolute no-brainer. There is so much value jam-packed in it for less than $10. It's going to be an 80 to 100-page book with so much information. Go pre-order it now because full price will be $14.99 and you're going to kick yourself for not buying it on pre-order. Now, you may be wondering exactly where in Mackay you should be investing. Well, that's what I'm here for. I'm going to help you out. Now, I use these metrics to filter down the suburbs. I'm not going to explain these metrics again. I've made another video about them, so go check that video out. But when you do use these metrics, you get a list of 5 suburbs, including Andergrove, Beaconsfield, North Mackay, South Mackay, and Walkerstown. On a very high level, Andergrove and Beaconsfield are very sort of good investment locations to consider. And the reason being is that Andergrove has all the right combination of metrics that we want to see. It's definitely grown significantly over the past 3 years, but there is still growth left in the market. There is still a very hot market. Stockholm market is rapidly decreasing with demand also increasing. We can see even more investor saturation because vacancy rates are starting to rise, as I've made this point clear before as well. However, one really good indicator to see is that affordability is still under the 30-year mark, which means that houses within that area relative to income is still very affordable, which is very, very good to see. And when you look over here, you can see Andergrove is right there, and next to it is Beaconsfield as well. And similarly, in Beaconsfield, we see very similar metrics, just slightly more growth over the past 3 years and over the past year as well. But a very similar trend of very low supply with very high demand, mainly because of the investors and the buyers agents and all the other retail investors as well. Very similar trend. As more investor saturation happens, we get higher vacancy rates as well. Now, we have a couple of other suburbs, including North Mackay and South Mackay, that you can consider. Of course, do your due diligence. North Mackay slightly lower on the socio-economic score with higher renter to owner occupier ratio, but a very similar trend of high demand, low supply. Similarly, Mackay, again, the lower socioeconomic area with a higher renter to owner occupier ratio as well. So these are my less preferential suburbs, you can say, compared to Andergrove and Beaconsfield. There's South Mackay, there's North Mackay as well. Now, one other suburb that you can see on the metrics is Walkerstown, which is this little location here. Now, it's really for the higher risk investors. I prefer to invest in Mackay if I can. One of the notable mention that I would say is the suburb of Bocasia. Now, the reason this didn't come up on here is because the vacancy rate is incredibly high at 2.9%. However, I do wonder if that is an anomaly of data. You can double check this with the property manager within the local area because it has a lot of the right metrics that I'm looking for, and it might be something I'm willing to trade off. Low supply, high demand, affordability is still very good with renter to owner occupier ratio and the socioeconomic score in the perfect sort of categories that I like, with a bit of growth that's happened and over the past 3 years as well. So Bocasia is one that I would like to mention that didn't fall under the metrics, but something you can consider as well if it suits you. Awesome. So what am I showing you right now? I'm showing you a property in Andergrove that is 10 Song Close, 3x2x2. $550,000, an ideal investment property that was sold on the 6th of January 2025. I know it's a corner block, so not perfectly ideal, but it's still a nice little property to buy. And I'm just going to use this as a quick case study and just to show you similar properties available for rent in Andergrove for 3-bedroom. You've got a couple for 3x1s, which is $750, $650, $640, and $700 per week, right? And so what we want to do is make sure we calculate the numbers correctly before investing into a location. And when we look at property in Andergrove at around $550, 12% deposit, $10,000 LMI, and you plug in the numbers, you need about $95,000 or so, maybe a bit less, maybe a bit more. At around $700 per week, you're at negative $10,000 cash flow. Now, that's pretty normal for most properties you buy these days because of the high interest rate environments we're on. That's just the reality of it. If you're at a 20% deposit, no LMI, your cash flow comes at a much better position, around minus $6,000. You're still negatively geared, but at a much better position. Obviously, you need a higher deposit, and if you had a better interest rate, then you could come into the positive, right? But right now, that's not a reality. We're at a negative interest rate environment. Now, you may also be wondering, well, your insurance seems quite high. Your council rates seem quite high. Well, that's the reality of buying in regional areas across Queensland. They have very, very high council rates. They just do. It's just the nature of investing in that region. And just to prove this point further, I've done 2 insurance quotes on the property in Andergrove. One you can see here, 4686. You can go check it out yourself and try it on TerraShare. And I also did another one on CommBank as well, which got to me about 4660. If you put the excess to the maximum, you get about 3.6. So anywhere $3,500 to $4,500 is what you're paying in terms of insurance per year for a property in Mackay. Make sure you consider all those factors in because your gross yield could be in a very good position, but your net yield after everything could be quite low. Now, again, I must stress the fact that every location and every property must be put into perspective of another property. The position in Mackay is not terrible, it's not great, and if you want quick capital growth, this is a location that you can consider. Mackay is a very, very popular location. So make sure you are doing your due diligence when investing into Mackay. And if you have any questions, leave it down in the comments below. And if you're wondering where else that you could be investing in Australia at this point in time in 2025, make sure you go check this video out.